And we're back. We got another one. We got another one here. Welcome, friends, family, people out there in the internet space. This is Epic Lunch and Learn. I think it's episode 16. We are, if you're in the West Coast, this is brunch time. If you're in the Midwest or the East Coast, this is lunchtime. So hopefully you stay hungry for some knowledge and we're going to bring it to you. This episode today is sponsored by Epic Mortgage. Whether you're buying, investing, or refinancing, contact Epic. That's 708-905-5300 is the office number. And make sure you take a look. Vince always wants me to throw this up, so I guess I will. He always makes me do this. But yes, the book is out. It's available. Ultimate Mortgage Guide. It's a blueprint for mortgages. You could check that out right on Amazon.com. After this show, I definitely want to direct you to our YouTube channel, Epic Spotlight. We do have our most recent interview is with Raina Kilgore. She's a family therapist. Had a great conversation with her. Definitely recommend that you check that out. And then I want to speak on some preferred listings. We have some listings that are available. We have 2436 Planters Mill Way in Conyers, Georgia. It's going for $399. It's a 4-bed, 2.5-bath. Contact Angela Pinnell, 404-425-4660. We also have 1100 South 3rd Avenue, Maywood, Illinois, going for, I believe it's now $394.9. It's a 5-bed, 2-bath house. The seller is highly motivated and is willing to give seller closing costs. So definitely check out 1100 South 3rd Avenue. Contact Tamika Bishop, 630-479-6352. We also have next property is 8228 South LaSalle, Chicago. It's going for $250. It's a 3-bed, 1-bath property. Contact Amico Pope, 808-428-3770. We have 5544 South California, Chicago, Illinois. It's going for $394.9. It's a 5-bed, 3-bath house. Contact Victor Naranjo at 708-830-4734. And we got some condos here. So we have a condo 548 East 50th Street, Unit 3, Chicago. It's a 3-bed, 2-bath. That's a big condo. Contact Jessica Roberson, 708-722-5106. We have 6945 South Dorchester Avenue, Unit 2S. Contact Evelyn Wood, 773-718-9742. People, don't forget, we do offer commercial lending as well. A lot of people just think we do residential. We brought commercial into the mix. So we do have 2 commercial preferred listings, 1413 East End, Chicago Heights, going for $165. It's a commercial storage. Contact Amico Pope, 808-428-3770. We have 1645 Western Avenue in Chicago Heights, going for $339. It used to be a former Burger King. Contact Keith Terry, 773-655-1360. And last but not least, we do have, we got 2 more. 14327 Lincoln Avenue, Dalton, Illinois, going for $225, 3-bed, 2-bath. Contact Evelyn Wood, 773-718-9742. And last but not least, we have a rehab that's available to you. If you're interested in doing a rehab, a renovation, a fix and flip, check out 7723 South Honorary Street. Contact Brittany Davis, 773-971-8714. And those are the preferred listings. If you want to actually see them, you can go to the website, www.DanteRoyster.com, DanteRoyster.com. You can take a look at our preferred listings that are right available there. You can also look at the Epic Spotlight podcast with some of the recent interviews that we've done. And today, we got 2 guests. I'm not solo today, so we got Gil Freeman and Marissa. Why don't you guys introduce yourselves? We'll go ladies first. All right, we'll go with Gil.
Hi, I'm Gil Freeman. I've been with Dante now for 2.5 years. Been in the mortgage business for over 30 years. Started with household finance, then with Tallman, and then LaSalle Bank, and then I started my own company in '96 through 2010.
Awesome. What was the name of the company?
Palace Home Mortgage Corporation.
Palace Homes?
Palace Home Mortgage Corporation, yes.
Got it. All right. Well, thanks for coming on. Marissa, can you hear us? She might be having some internet. I think she was trying to stream a stream. So I don't know. So I don't know, that internet's doing goofy stuff. But Marissa Hazelwood is a loan officer as well. I thought it would be fun today to have loan officers here, and really just talk about from when you started, Gil, to where things are now. I mean, obviously you're a seasoned veteran. You've seen so much of the landscape, and I'm just curious, so we could have some reflection. I'm not trying to make it a tearjerker of remember when, but just take us back. What have you noticed the difference has been with real estate and mortgage,
But
just from when you started to now?
for sure, it's been a big difference because when I started in the industry in 1990, I started doing originating. Prior to that, I was doing REOs for LaSalle Bank.
All right.
I started originating in 1990, and we did. We had pagers at that time. There was no online applications. They were typing loan applications and faxing them over to title companies and things like that. So we had no automated underwriting. Each file was underwritten manually by the underwriter in the company itself. So it was all antiquated to a certain degree because of the fact of it was a slow process. It's a lot longer than, of course, now, but because of the fact that everything had to be hand typed. If there was corrections, they had to retype the application. At that time we had a 3-page, 4-page application that had to be retyped on the typewriter. So, based on now, those things have definitely changed. And there was no online, advertising. At that time, you solicited by going out, meeting brokers, meeting realtors, meeting builders. You had to actually get in their office. If the customer couldn't come to you, they couldn't do an application online. You had to actually meet with that customer to get the application done.
No, definitely. I have a friend that's a loan officer. He works for a different company, and he still meets with the client, sits knee to knee, meets with them, and fills out the application. Now that does provide. I mean, I would hope it provides clarity and a clean application, because obviously, to your point, now things are automated. Most times when you're working with with a loan officer, they're going to direct you to some type of website or some type of intrasite where you fill out your information. But giving 100% control to the consumer to fill out their application, let's get some sentiment. I mean, it's not always right. Am I correct on that?
Absolutely. It's definitely more personable to be in front of the customer. And like you say,
Sure.
you can eliminate mistakes, because I've noticed online I've missed some things as a customer go in and fill it out. You just can overlook some stuff that being right in front of them, going over the application at the time of application, then you usually get things right. Normally you do. Yeah.
Marissa, go ahead and introduce yourself.
Alrighty, I'm sorry I had technical difficulties. I'm Marissa Hazelwood, a loan officer here with Epic Mortgage. However, I started in the industry as a funder with Wells Fargo back in 2000, I want to say 11, 12, and somewhere around that time. And during that time, I would say it was like mortgage industry was a cash machine. Like files were flying across my desk, 40 going north during that time. So I definitely have experience of knowing what the industry was then versus now, and it has been a completely game changer.
What have you seen has really changed things in your perspective?
Back when I was a funder, as I mentioned, files were flying. I was closing maybe 20 files a day, like literally. And my bonus depended on it. So trust, I was on top of it. But during that time, it was just more lenient. It wasn't as scrutinized as it is now. Underwriters were more relaxed, didn't have many questions as they do now. You can get a file through to closing in no time, in days, if you have the proper documentation. Um, During that time, we were seeing all type of loans, but the main three I would say were like stated income or what we call liar loans. You just whatever you put on the application is what we go by, and it will get passed. You'll see a lot of arms, which was, putting a lot of buyers in a hectic position. They start off with a low rate and then payment double, triple, a year or two later. And then they wasn't in a position to handle that. So that kind of, messed up the market, messed up a lot of buyers. And then during that time, there was minimum documentation. Underwriters really wasn't asking too many questions. It's if you have it on the paper, you put it down, it was flying pretty much. It wasn't as a deep examination as we see today.
No, definitely. I remember I got in the business June 24th, 2002. June 24th, 2002 was my first day in the business, and I worked for a direct lender. And I remember the leniency, and I think the leniency came. Products that were there are still now back, but I think the difference is the credit score requirements have
Mhm.
changed. You
The
could get
credit,
yeah, the credit scores, right? I mean,
yeah, credit score as well as the loan of value as well. Down payment amounts change. I think that, like you said, the products are still there, but you don't have 100%, loan of values anymore.
correct.
700 scores, no income, no asset, no job. So to
Correct.
speak.
And, I remember like instances where I closed a 500 credit score with a conventional product.
Yes, I
Conventional
remember that.
500 credit score. 5% down, 3% down. That was a thing. Now, if you're a 500 credit score, you have to put 10% down if you can get approved. Um,
Yes.
now let's talk about AUS and automated underwriting. Let's bring that up a little bit, Gil, because what it sounds like prior to maybe 2000 ish, 1996, right around there, it was basically manual underwriting, right? It was subjective.
Everything was manual, with underwriting, and it was very subjective, because I've had underwriters, with favoritism to say, "Hey, Gil, what do you think about this file? It appears to be a good one, and then they make a decision based on, maybe that they might have experience with that particular customer. Now with AUS, it pretty much lets you, once you get that approval, you just follow those guidelines. Normally, whatever they ask for in the AUS approval is what the underwriter looks for, and they document and they get ready for closing the file. But before, it's definitely subjective. I mean, it depends on the underwriter that got your file,
Mhm.
whether you have a rough time or a good time as far as getting that loan approved, based
Yeah,
on conditions and stipulations and things like that.
no, definitely. I think there was a situation, just underwriting in general. I mean, they're kind of like the goalies, right? If we were playing soccer, their job is to protect, their lender and make sure that they're not, accepting or funding deals that are not going to go, are not going to pay, right? Insurable loans. I mean,
Sure,
so two things happen on the back end. The most of these lenders are going to sell the rights of customer service to another lender, right? They're going to, there are businesses that have been set up. They're like, hey, I'm Mr. Cooper. I just want to make paint. Or, well, Mr. Cooper just got bought, right? But some people are built to be customer service, and then some are built to just fund loans. Hey, we're just going to get this loan done. We have a warehouse line. We're going to fund this loan, and then we're going to sell the customer rights, service rights to the loan to somebody else. And then I think there's a, from an underwriter perspective, is it insurable so that, the company can sell it? And then also too, is this person going to basically have the ability to repay this mortgage back? Because if they don't, it goes on my record. And that dynamic changed things, definitely, because now there's more scrutiny. I think these underwriters are just, crossing T's, dotting I's, and maybe sometimes, asking just too much, getting too much.
I agree.
So what do you say about that, Marissa? I know you've had a couple files,
Like,
so I
did you
mean,
hit your big toe?
man, too much.
um,
Um,
I feel, yeah, these underwriters, one, coming in the industry and just working in the bank, in my past, I know for a fact that the experience level may not be there at times. They don't require you to have too much of experience to get into this side of the world. So today, I feel like compared to what I worked with in the past, the underwriters, not the loan officers, they're kind of inexperienced. They don't have they know the standards. They could read the book, read the rules, read the guidelines, but don't know how to really apply them. And so that's what really has them over questioning our borrowers these days, asking a little bit too much. And I get it, you want to dot your i's, you want to cross your t's, but I think the level of experience of the underwriter really matters when you're closing a deal.
No, definitely, I agree. I mean, obviously, one of the beauties that we possess as mortgage brokers is having the ability to shop around for a lender that can that's suitable for our client, right? We have the ability to kind of bounce around, but a small downside is that we don't always have that same underwriter every
Right.
time. So we more than most have to deal and be flexible with multiple underwriters across the country. And now with this whole remote business that we're in, right? Everyone's remote. You know, all three of us are not in the same location today. All three of us are not even in the same city.
Sure.
It's just one of those things. I mean, same with these underwriters. And sometimes
Hmm.
I'm just curious. I ask them, and like, where are you? Well, I'm in Florida. I'm in Texas. I'm in Idaho. And it's like, dang, I'm in Minnesota. I mean, they're just all over the country. Primarily working from home,
I was just
and
gonna say that.
right, working from home. And it's just one of those situations where, what underwriter did I get? How much experience do they have? Can they, hey, I gave you this. Can we button this up? Can we make the story work with what I provided? Why are you asking for more documentation? Because that's a frustration from clients, right? I mean,
Hmm.
what are they telling you?
Gil, you want
Well,
to take that?
yeah. What the client gets frustrated because if once the underwriter gets the file and the client provide information, and then the underwriter asks for some additional information, that's when the client starts to get frustrated because now they're saying, okay, well, what's the problem here? I mean, you asked me for this and I gave it to you. Now I need this, so I now need that. So the underwriter is not consistent as far as what they're asking for, what they need, and you provide. And I understand if you provide something that requires additional documentation, that's one thing. But if you give them what they ask for and then that doesn't satisfy them, that's frustrating to the client, and it comes back to you too as a loan officer because now the client is doubting your professionalism and your ability to understand loan processing and things like that.
Marissa, what do you say?
And it kind of becomes discouraging, right? You're in a process where we give them a pre-approval, and most people think the pre-approval is the green light, it's good to go, I'm gonna get through it. But as the underwriter is questioning every single thing, even me as a buyer, I would kind of get a little discouraged through the process. Is this really gonna work? Is it really gonna happen? Why are they asking for more documentation? So it can make the buyer feel a little discouraging during the process because they're just not 100% sure, or don't know the process, or don't know why the underwriter is asking for what they asked for, and unsure if it's really going to happen.
Yeah, I think from an expectation standpoint, from a loan officer, we're trying to set the table up. We're trying to give the expectation to our buyer. And also our realtor. Our realtor in most cases are our business partner. And so we want to say, hey, business partner, if you provide us a client, they're going to have a great experience. They're going to have this great experience with us, working with us, versus somebody else because we're going to navigate and get them through, but at the same time, everything has to kind of go right. And the funny thing was yesterday I was talking about how just a real estate transaction, a purchase, in Illinois, there's 10 people involved in the transaction. 10, buyer, seller, listing agent, buying agent, loan officer, underwriter, funder, title person, and then 2 attorneys. It's 10 people on a transaction. And so you're trying to navigate because, once the realtor gets them under contract and passes the ball, they're expecting you, all right, get it done.
Do
And
what I got
and
to do.
Okay.
so, one hiccup, one extra. And our conversation yesterday was talking about buyers and just some of the delays in the process, and that's all towards trying to have a great experience. We want people and consumers to have a great experience. I think we're all passionate about real estate and mortgages. And let's just spend a little time on why are we passionate about it. I mean, what is it that made you want to become a loan officer? Who wants to take that first?
Go ahead, Marissa.
I will take it. I'm passionate about it because it's really aligned with my purpose. My purpose is to uplift the urban community by providing financial products and services to help them grow and build wealth. So I felt like well, coming, I don't know how I got in the industry. I just jumped in. No, actually, my brother is a realtor, so I jumped in with him straight out of college. He was the first person to offer me a job, and so I like it, and it really aligns. I have a degree in finance. I have a degree in accounting, so it kind of just fell in place to my purpose in life which is to help people understand financial literacy.
What about you, Gil?
Yeah, with me, I've, like what my degree is in finance and management. And as a teenager going into college, you know, real estate is something that was always interesting to me. And to figure out how, because back then, if you didn't have the experience in the business, it was tough to get in. So just to figure out, well, go, because I used to go around look at different houses and say, well, I wonder how do they buy that? So just the curiosity of knowing what the procedure is of getting people involved, getting them in a loan, what do they need, why do they need it, how much do they need, things like that. So that just perked my interest to just get into real estate, and I started, doing loans, and then it went from there to selling real estate. So just that real estate industry altogether, homes and investments and things like that, was just something that just piqued my interest.
I know I came right from college and I was still trying to pursue a career in sports. And so this was just a job, it was just a hold me over. I didn't really, I wanted to have, some money in the pocket, but this was just supposed to be a temporary thing. It wasn't supposed to be a 23-year and counting career. And so, at the time, it's just a job. I didn't treat it anything more than just, hey, go in there, what hours I need to be here, and then keep it moving. But my first client that I got, and I kind of write it in the book actually, Eugene and Booker. I'll just leave it like that. But I was able to help them refinance their mortgage, and at the time, they were just heavy in debt, and I probably saved them anywhere from $700 to $800 a month, and then I got paid for that, and I just was, kind of stopped me right there, like, wait, I got paid, and I helped them. I really did help them, and there
Mhm.
was a feeling of like exasperation, like, oh man, thank you. Like, man, we've been so tight, fighting and surviving, and now this little breath of fresh air was going to be so pivotal in their life. That motivated me, and I was like, man, this is a win-win. And I've always kind of stuck with that mantra of like, you know, this is a win-win. I'm winning, but you're winning. And as long as I keep you winning, then everyone wins. It's a game where there doesn't have to be a loser. Obviously you come from sports, there's winners and there's losers. And that's what I came from. It's like either I'm gonna win and you're gonna lose, or you're gonna win and I'm gonna lose. And so to be in something where we both can win, I thought it was awesome. I was sold right after that. I was like, hey, this is great. I gotta learn this. I gotta learn more about this. So it was one of those situations. I just thought I just have always loved it. And then obviously, and that was at a young age when I got in, so I was still young, and you know, I didn't even know the power of just overall, what real estate can do and how it can really help. It took time for me to mature and have life experiences, and then that's when I really started gathering, like, wow, look at what real estate can do for you. I mean, and I'm sure you guys see that just in friends and family and yourself, right? I mean, just how powerful real estate is. I mean, what are your thoughts on that?
Yeah, I mean, it's
Uh,
Go ahead, Marissa.
It's the asset out here. Beyond the stock market, right? We know that houses going to always appreciate. It's very rare that we see that the housing market depreciate. Probably only saw it maybe 3 or 4 times in the history of real estate. So it's the best asset out there, if you ask me. So I think it's a great thing on both sides, being a buyer or being a worker in the industry.
What do you say, Gil?
Yeah, it's the biggest investment that most people make in life. You know, they and it's one of the most, you know, and it's location. But in most cases, you don't lose money in real estate. You know, you get appreciation anywhere from 5 to 7% a year, and it's like you say, it's like having a stock, and that you don't have to watch as much as you do in the stock market now, buying and selling. But it's a piece of real estate if you're buying in a decent location that you can buy. My first house I bought for, you know, 30,000 and sold it for 110. So
come on now, say that again now. Don't be modest about that. Come on now.
So value there. It just appreciated. I kept it in maybe like 7 years and sold it. So the market has continued to appreciate, and you can't lose in most cases when you purchase a real estate. So whether it's an investment, whether it's a single family primary home, it's the biggest investment most people make. And if you look at the wealthy, it's real estate that drive their wealth.
I think the number is 85% of all millionaires have a real estate portfolio.
Yes.
So,
Yes.
I mean, the numbers don't
That's
lie.
true.
Numbers don't lie.
Right.
You know, and I think, you know, but sometimes, you know, we get stuck in this popcorn age, right? So now we're bringing it back to now. Everybody wants now. They want instant gratification.
Instant. Yeah.
And that's where real estate can be tricky because, you know, it's not really a popcorn, you know, to your point, the 5 to 7%, it's still going to take time, you know,
Right.
to see the
Right.
true power of real estate. How long did you have that one property? I'm just curious.
7 years.
And that's when, you know, so I mean, you know, to some degree, you could say 7. I've always said 10, you know, but, you know, somewhere around that 10-year mark, that's when you start seeing that pop.
Yeah, the biggest thing for me is I bought one, you know, and I won't say it in town, but it was like 7,000. I put 30 in it, sold it for 65 in 30 days. It's a great deal. I mean, and when I did that, I goes, man, I can't lose with this. You know, so it's a great investment to get involved in buying and selling if that's what you want to do, and even if you're buying and renting, but you know, based on what area you're in.
Now,
Awesome.
Gil, how long ago was that? The one you
That
just
was
mentioned.
that was back in the early 2000s. That's before the crash, 2008. You know, that's like 2002. You know, I remember that specifically, that particular one that I did like that, because that's when I started my mortgage company, and I was back investing in real estate in 2002, the year my mom's passed. So I remember that one property. I was watching the contractors because I don't. When I was in REO, I was taught how to, and REO is real estate owned, how to look at properties and see what the cost would be as far as rehabbing. But I couldn't do anything, but I knew what it would cost me to rehab it. And I knew that if I got this for 7, everybody was saying, well, listen, dude, you buying this at 7,000 and it's a 2-bedroom, you got to be nuts. But I knew that, you know, the market was 65, and if I put 30 in it, it's almost a brand new house, a small house, and boom, you know, it flew. I mean, it was 90 degrees that day when I sold it. It was, you know, I had the air conditioning going. Yeah, we wrote the contract in the house.
Got it.
Oh, that's awesome. Hey, now we do have some questions here, so I'll start rolling out some questions. You know, so for people on Facebook, people on LinkedIn, people on YouTube, hey, just put it in the comments. We see them, we'll get to them, and you know, we'll try to answer your questions. So we got a question here from Dixon. How different was the buyer experience in the early 2000s compared to today? What would you say, Gil? That's 100% you, I would say.
Yeah. Well, I mean, when you say the buyer experience, because back in the 2000s, you had so many different products, and so that made that put a lot of potential buyers in the market, because they could almost do practically anything. If you had a 500 score, you could buy a house back then. So it just opened the market up. So now it's a little different, because you got to have a 580 at least, and then you got to worry about underwriting and things like that. But back in the 2000s, there was no ceiling on the type of financing. So you just open the market up for everybody in the industries. You get more buyers than you do have right now in purchasing.
Awesome. We got another one here from Chris. Do you think stricter lending rules protect buyers more than they hurt them?
That's a good question.
You know what? I'd actually say, do you think stricter lending rules protect buyers? No, they protect the lenders. These rules are based for the lenders so they don't get burned on the back end. They want to know, who are they lending money to, and will they pay them back? Their business is based upon, let's take a home right now in the marketplace going for $300,000, right? You're going to put, let's just say you're going to put 10% down. So you have a loan amount of $270,000. All right. The way banks make money is the interest on that 270. So they're going to, give you a 30-year mortgage. That's 360 payments of principal that you're going to mandatory have to pay. And then you're going to have interest tacked on to each of those principal payments. So even though you have a loan amount of 270, back in the day, we had the truth in lending. Gil remembers the till. And that would always scare people, because it's like, wait, I'm going to pay back $546,000. I thought I was just getting a loan for 270. Yeah, you are, but that's included with the interest.
Interest, right? Don't forget that, peeps.
Man, so that's truly how banks make money. They make money off the interest plus the principal. Well, the interest really is what they're making, and the principal is just paying them back. So, so the rules are based upon them. What happened, in my opinion, is in early 2000, to Gil's point, all these products were available to all credit scores, and what they do is they have to do a review, quarterly, yearly, semi-yearly review of who's paying. And unfortunately, people with lower credit scores tend to get themselves back into trouble, whether it's bad habits, they lose their job. They lower credit scores will tell you a little bit of their financial responsibility. Not to say they're bad people. I know some great people that got 450 credit scores. They're great, make you laugh, nice at a party, but I may not lend them any money. May not lend them any money. So I think that's the best way I would answer. Anybody want to add on to that?
It protects the lender, of course, right? Because I'm giving you my money, but it also to extent protect the buyer. Back then it was easier approval. You had a harder future, it was, can you afford this in the future? Versus now the approvals are a little more harder, but then you have a safer future. We're actually examining, can you afford this versus just letting paperwork fly.
Yeah, I kind of agree with that. Lenders, it protects the lenders more so than the buyers. But I mean, because I remember doing with a customer doing that. They had seller carrybacks. Remember those back in the day? They had those seller carrybacks, and actually a client would go to the closing and get money back from a purchase. So yeah, it protects the lender more so than the buyer. I think that that was one of the reasons of the crash in 2008, because of the fact that the lender wasn't protected and the buyer was were given products and programs they really couldn't afford.
Got it. We got another one from Clive here. Do you think we'll ever see lending loosen up again like it did before the crash?
I don't think so.
No. Unless it crash again.
Not because before the crash, you had 100% stated loans. All you needed was a credit score, and you can get a loan with no money down. And that's anybody. You don't have to be a veteran and under that. So, no income, no asset, no job. And you were getting loans back then. So I don't think we'll ever see that again.
It's a shame too. I mean, in theory, I mean, as we're just talking about it, it's a shame on the concept that if people would have just, didn't abuse these loan products and taken advantage of those opportunities. I mean, God, there's so many opportunities out there. I love to where I only have to pay closing costs and I could go get the property, but too many people that didn't have a plan, didn't have a budget, got themselves, head over heels, and then they fell on their face. And one time I remember I was doing some property management for a lady, and she something about the tenant wouldn't pay the rent, and I was like, hey, they're not paying the rent, but they got to move out. And she's like, well, if they not gonna pay the rent, I ain't gonna pay the mortgage.
That's
And
not
I was
how it
like,
works.
no, you gotta pay that mortgage still. That is a person that got in with 100% financing, didn't have the wherewithal to juggle two mortgages at the same time, and were 100% reliant on that tenant paying, so then they could take that money to pay the mortgage. And that's not how it works.
No,
If
it's not.
you got to be able to make that payment, right?
Yeah, absolutely. Absolutely.
Regardless of the tenant. So yeah, and we want, yeah. So I mean, to some degree, I don't think I'll ever be there. Now, what's interesting about this, and I love to get your guys' comments, just what's going on with where we are as far as the Federal Reserves, the president. I mean, he's really making a push right now to try to reduce the rates.
Mhm.
I mean, and he's calling on other people. I've never seen so many people like talking noise about our federal chairman before. I mean, I was like trying to go back in time.
Because he used to be a god, the federal chairman. Now it's like this guy he's an idiot and he doesn't know what he's doing and things like that. I'm like, wow. So
He's one of us.
yeah.
Hey, I mean, I counted. I went. I just looked right now. I think there was like 5 federal chairmen since I've been. Like
Yeah.
Alan Volcker, Greenspan, Bernanke. I can't think of the lady, and then now this guy, Jerome Powell.
Yeah.
Um,
Greenspan
and
was my guy. He controlled the market big time, so I
and
mean,
he was
well,
through
being a
multiple
chairman.
presidents. He was
Absolutely.
multiple presidents, right?
Yes.
Yeah, I mean,
Yes.
highly respected guy, and and Jerome Powell, to his credit, or what he's going through is, he was appointed by Trump in
Right.
2016.
Sure.
Mhm.
Mhm.
Now, one thing though is his history as being the federal chairman. He has always looked backwards. He's always looked at reports to make decisions on how to move forward. But his rhetoric now talks about, well, we have to wait to see how the tariffs are going to impact us. And so that's the only contradiction that I do. I see the agreement to have some, just like discern for him. It's like, hey, guy, you've always done it this way. Now all of a sudden you're trying to look forward and pause. We're trying to have, I think just human beings, Americans, we just want, like, what are the rules? If you're going to look backwards on everything and make decisions, then that's what you do. Because if you look back at things, the rates would already be lower right now. And I think that's where the issue lies, is because now he's kind of he's changing his tone in the 9th year of being being the chairman. So I don't know about loosening products per se, but definitely it will open up the door if rates do drop.
Absolutely.
Yeah, I think right now people are saying, "Whoo, I'm a little squeamish. Rates are higher than what I'm used to, and the values skyrocketed because of the pandemic." So that's what I'm seeing. All right, Anita, are today's underwriting systems more fair or just more complicated? That's a great question. What do you guys think?
The system is a robot. So
We got AI.
we got AI, Bennett AI. And I don't think AI is, I know a lot of people is against robots doing a lot of the work and scrutinizing a lot of things these days, but My personal opinion, moving to the future, I think it's just as the same as it was in the past. It's just built into a robot now, right? They're doing the work for us now versus the past where we had the underwriter manually looking into everything. But to me, it's the same rules, same guidelines. It's just done a different way.
What do you think, Gil?
Yeah, that robot was supposed to take out the subjective underwriting and make it more objective now, because if you follow the robot is going to be consistent with whatever the guidelines are. So uh, if without the robot, you still got underwriters that use their subjective thinking sometimes, as opposed to being objective when they're making decisions on whether the file is approved or disapproved. But having a robot, I thought that would bring consistency to the industry far as making a decision as far as what file would go. If this guy's got these documentations done on this particular file, then it's done because the robot said so, because the robot's following the guidelines. And I think that was the whole purpose of the automated underwriting, to make it easier, faster, quicker, and less subjective.
Yeah, I would agree with that. It was supposed to be that way, and
Right.
and sometimes it just doesn't work out that way. And
Mhm.
what we have seen is obviously, now bringing this back because you talked about it. Just once we have a contract, we get your documents. We're going to submit it to the underwriter, right? Every lender has underwriters, and so when we submit it to the underwriter, they're going to give us what is called a conditional approval, sometimes also known as an initial approval, and it's going to give us conditions. And to Gil's point, it should read what the AI has already provided us. But the issue is sometimes these lenders will have what they call overlays. They will have additional items and go above and beyond those documentations. Another situation that does occur, and we don't have to talk about it now, but it's like when you submit documents to us, depending on, large deposits or other things that you got going on, especially in bank statements, now you've opened up Pandora's box on additional, items that we have to talk about. It's like, well, man, you asked me for this, and now you asked me for this. Well, this condition you provided now has opened up this new condition. Now we got to figure out how to get through this one. It's the issue always to me stems from the fact that there is no there's not enough. There might be some classes, but there's not enough. Just how to be an adult classes in high school. This is how you balance a checkbook. This is how you buy a house. These are the things to avoid. These are the things to, we don't really give a survival class for people. And then we start falling into the lottery game of what's your last name and when were you born, because what's your last name will dictate who your parents were and did they give you, the environment necessary for you to have some of this knowledge, because it's just not readily available.
Mhm.
And that's the major issue. And so, it's one of those things. I would say, to your point, underwriting systems, it definitely was trying to get rid of the bias. I had a gentleman, and we were actually doing a manual underwrite, and this is a long time ago, and I could tell the underwriter didn't like him. He didn't like the guy. He didn't like him. He didn't, and it was just a situation, and but it was like I got AUS approval, so no matter what you say, you can't deny this guy,
Um,
no matter how ugly, sloppy it is. But to some degree, the underwriting system, and I've played around in it. It's been somewhat, in this conspiracy theory, it's been somewhat biased at times towards income. So you could take a 580 credit score who makes $9,000 a month and it gets approved. But if you take that same 580 credit score that makes $3,000 a month, he doesn't.
no go.
So, why does income, make a difference? Does the AI think, well, he has a better chance of ability to repay? I don't know. Is that right? Is that wrong? But I've seen that. I've seen similar scores, but based on income, One gets approved and one doesn't. So, I mean, those are things that I would say sometimes it has complicated because you guys know this. When we get what is called a refer eligible on a AUS approval, aka a red light, right? We can't move forward with a refer. Hopefully, we're going to look at see if we can do option B, which is manual underwriting. But if we get a refer, it never gives you, hey, Gil, this is why it got referred.
Mm-hmm.
We have no clue.
We don't know why. Yeah.
Yeah.
So, I mean, why is that? I mean, why are you not helping us, coaching us so we can let the consumer know, hey, do these things so we can help you? It's almost like, well, no, we don't want to coach. We don't want you to coach them. They don't want them to be prepped just to pass this test, because passing this test means now it's on our books. And if they still have those bad habits, we're going to see it because they're going to end up not making the mortgage payments. You know, that's conspiracy theory, but that's kind of what I feel like sometimes. We're not going to help them pass this test. Either they can pass it on their own or best of luck. What do you guys think?
That's pretty much what it is. Yeah, you're absolutely right. I mean,
I totally agree.
There's no rhyme or reason of why, but that's just how it is. You know?
Man.
Yeah.
You know, and so that's why, to some degree, and I think we're all fans of this, we try to do the work up front on the pre-approval.
Yeah.
You know, there's a lot of loan officers out there. They're pulling one single bureau credit. They're not looking at all three because of, you know, the cost. They're just doing, you know, sometimes not pulling credit and just issuing out pre-approvals, guessing, hoping, praying. And those aren't things that, you know, are good habits to have. And that doesn't instill confidence in your pre-approval when realtors are going out there working on your behalf because they got this pre-approval and now you can't deliver on the back end. So we hope that you are listening to us today and recognizing we do it the right way. You know, sometimes we get these calls, right? The realtor calls you. Oh, I got an offer from your client. I just wanted to go over and make sure that, you know, A, do you pick up your phone? A, do you respond in time? All that good stuff. And so, you know, I'm like, and the questions that they ask sometimes, these realtors ask these questions. I mean, come on. Did you pull their credit? Did you look at their income?
What taxes did you use?
Yeah.
Like so many questions.
I don't, hey, they got to do their job. I get it. But I feel bad. Like, damn, you have to ask these questions because someone didn't do this stuff on another deal. You had a bad experience, right? We're all based on our experiences. And that's where I'm like, damn, they didn't do that? Man,
Right.
but you know, and we hear it all the time. So it is, I don't know. It's just one of those things. All right, next one up. I've got another question here. What's the biggest lesson modern lenders should take from the 2000s? Oh, thanks, Dirk. That's a good one.
Oh, that's a good question.
What do you think?
From the 2000, what it taught us is just because you can close a loan doesn't mean you should, right? We have to learn the hard way with easy approvals that easy approvals can potentially create long-term problems, not just for the borrower, but for the agent, for the lender, and for the entire like economy, right? If somebody loses a home, the community lose stability. And then, you know, it's at a point that the community losing stability and the trust is broken and it's really hard to rebuild. So I would say the biggest takeaway was just because the loan can close don't mean that you should.
Yeah, no, I think this constant tweaking that we'll see just from lender to lender as they always evaluate, you know, their pipelines, their databases on, you know, what is performing. You know, lenders use the term performing, and they're talking about the loans, who's making the payments on time on the back end, and that will always steer them into what products are available, you know, based on what the market's doing. What do you think about that?
Yeah, like I say, the risk involved. If lenders now, you know, they have to be cognizant of what happened back in the 2000s based on the risk factors. You know, based on, okay, well, Yeah, and I think that's part of what's going on now. Just to say, okay, do we have the ability? Do this particular client has the ability to repay, and if so, why? So if they didn't learn anything, they should have learned that back in the 2000s, like Marissa says, just because you can close a loan don't mean you should. Yeah, I agree with that 100%.
Nice. Um, got some last minute epic panel. Keep it going. Appreciate you. Thanks for listening. Thanks for watching. And a great video. I'm learning so much. We appreciate it, Jason. Make sure you give this a like where you are. So if you're on Facebook, give this a like. If you're on LinkedIn, please give this a like. It goes a long way in the algorithm, that invisible monster, so it can tell others about this information we're providing. If you're on YouTube, yeah, definitely like and subscribe to the YouTube channel. So I appreciate you. We're on a path to get to 2,500 subscribers. I think we're at 2,430 right now, so we're making our way to 2,500. So appreciate you if you can help us get to 25. That's our next goal. Let's get some contact information as we're going to start winding this down. I do have some questions for you guys, but let's get some contact information. So where do they reach you, Marissa, if they need to talk to you about a mortgage?
If you want to talk to me about a mortgage, you can reach me. Cell phone number is 773-290-9929. Like he said, we are a broker, so I'm available 24/7 pretty much. And then
Oh, I think we lost her.
We lost it. Looks like it.
Go ahead, Gil. Where do they reach you?
They can reach me at 773-230-1947. And my email address is gfreeman@epic.mortgage.
Appreciate that. Hopefully we can get Marissa on. I had a couple questions that I just wanted to kind of finish up with. I thought it'd be interesting. Question number one, Gil. Why do deals really get delayed, and who's responsible most of the time?
Well, I think it's if the loan officer. I think because if you do your homework up front, and you have what that should be required in the file, then submitting the file. If you submit a complete file, it shouldn't be delayed. So I think it's the loan officer that is the reason for delay. And if the loan officer has requested information and the customer has not provided, then it can slide to the customer. But in most cases, it's the loan officer.
Yeah, I mean, yesterday I was ranting about the customer on that type of mindset. But to your point, I mean, it's a team game. We have to work together to get the job done. So
Right.
whether it's a loan officer or if it's the consumer, we got to work together and obtain this documentation as quickly as possible. Marissa, you're back. Can you finish what you were going to say? Where can they follow you? Can she hear us?
I can hear you now. I'm having so many technical difficulties today.
Oh boy. But where can they follow you? Where you at on the internet?
You can follow me on TikTok, Mortgage by Marissa H. Instagram and Facebook, it's just Mortgage by Marissa.
Awesome. I had a couple quick questions I was going to ask you guys so we can wrap this up. So Marissa, what's more likely to delay your closing, an appraisal or title?
Appraisal. That takes the most time. We got to get, it's probably the longest in the process, right? It takes nothing to get the title. Long as nothing come back on the title, that can be a delay as well. But most titles come back clean. But I would say for me, appraisal, it's a little process to get the appraiser out there, appraise the house, and get his report back. So that's would be the biggest delay on my end.
Got it. Gil, what's the most common borrower mistake that holds up closings?
The most common borrower mistake that holds up closing is funds for closings, not being able to document funds needed for closing.
So they got it, Gil, but it's not documented.
I think you got one right now you're dealing with, so I understand. I understand. Hey, Marissa, how do underwriting backlogs happen, and what can you do to speed things up?
Underwriting backlogs is pretty much, a lot of loans in the pipeline, right?
Correct.
Um, I personally, I like to reach out to my underwriters personally. If I'm working on a file, I do understand their turnaround time. I try to be on top of the turnaround of time, but initially when I submit the file, I like to introduce myself to the underwriter if it's someone I haven't worked with before and build that relationship. Everything is relationship based in this world, right? So build that relationship in the beginning that help your file move smoother.
Awesome. Gil, what role do real estate agents play in avoiding or causing delays?
Well, the biggest role that real estate agent could play in that and um, is not getting accurate information from their sellers to make sure that the seller, number one, can afford to do what they say they're going to do, or they're going to regarding the sale and regarding the transition itself, if it's doable for them to close the deal and they have enough equity to do so.
Awesome. Marissa, what are hidden delays nobody talks about enough, but every mortgage pro sees?
Oh, that's a good one. Hidden delays. I would say the appraisal. That's number one. As we mentioned, it is a little process. And then say it come back in low. That's another delay because now we got
Right.
to go back to the seller and negotiate or have them come down. So I say appraisal may be one of the hidden delays. Title can be a hidden delay depending on, if there's lien on title, anything going on with us that the seller didn't inform us in the beginning. Those will be probably the two major two.
Yeah,
And as Gil mentioned, funding.
gotta have the money. Gotta have the money. Can't close without the money. You know,
Right.
one thing too is PIAs for everyone out there. Personal identity affidavit forms are being sent out. I mean, they've been sent out for a couple years now, but that's a big thing in the title world. They send out these PIAs, during the purchase transaction process for the buyer to fill out, and then they run, kind of cross check your name through the database, making sure there's no IRS tax liens, state tax liens, make sure that you are eligible for financing in that state per se. If you had any criminal background, so that's a major thing, and that we can't forget about. That is a situation that we have to pay attention to. So just be mindful, because those are definitely like little landmines. If you the surprise, and sometimes buyers, just due to their schedule, or maybe the attorneys don't get it to you right away, you don't fill those things out, and then all of a sudden on closing day we find out you owe $3,000 because you have a state tax lien. So be mindful of PIAs. That is a thing that has stubbed the toe of many people. And then as we wrap this up, Gil, what's your best advice for buyers and sellers who want a smooth on-time closing?
My best advice for buyers and sellers is that if you get everything that you need at closing, if the buyer gets everything that's required of them as far as the loan application, and then if the seller respond quickly to whatever stipulations the buyer might have as far as the contracts or inspections or anything like that.
Awesome. I appreciate you guys coming on today, and to Epic community out there listening. Thank you for listening to us. We're going to be back tomorrow with Vincent Bertuccini and Michael Kamey. Michael Kamey is going to come and talk about housing design. So that's going to be pretty neat. He has a structural and architectural design. So definitely check that out for tomorrow. We hope to have Gil and Marissa come back. This was fun. And, before you blink, it's been an hour. So definitely, if you're interested in our preferred listings, go to www.danteroyster.com. You can see preferred listings that, we can help you get those under contract and get them to you. If you're looking to buy, if you're looking to invest, definitely contact us. We can help you. The corporate office is 708-905-5300. 708-905-5300. And then once again, if you're looking to refinance, restructure debt, get cash out, definitely give one of us a call. We can help you. This is a great time. Like I told people yesterday, I heard the Feds are talking about lowering rates, in their meeting in September. That's already baked in. That's right now. So if you want to take advantage of those opportunities of a lower interest rate, opportunity to get some cash out, now is the time. Don't wait until September 17th. We already anticipate that. It's a 90% chance that that's already going to happen. That's baked into the mortgage rates right now. So take advantage of the opportunities that are available. There's a lot of appreciation on everyone's property if you are a homeowner. So take advantage of it, and let's have an epic day. I got to get back to work. How about you guys?
Thank
I
you.
have to get to work too. See
All
you
right,
guys
take care.
later.
All right.
All right.
Bye bye. Have a good one.
Bye.